Morning, David. Thank you for having me on. And a bit of a mouthful there in terms of the amount of products that we sell, but we'll take you through that. If you can move to the next slide, please. The short of it is in a 2-minute video explaining our organisation, and we'd like to sort of present that to you now, and then I'll come back online and take you through the rest of the organisation.
Founded in 2014, Stealth Global Holdings is an Australian publicly listed multinational distribution group. Our strategy is to establish a large-scale, diversified, market-leading industrial MRO supplies organisation. We operate in the geographic locations of Australia, the United Kingdom, Africa and Asia. Since listing on the Australian Securities Exchange in October 2018, Stealth has completed 5 acquisitions and established a joint venture with Bisley Workwear in the United Kingdom. Our portfolio of businesses are leading brands with long operating histories in their markets. We hold an advantage position with our wide-range product offering, high-touch solutions model, store network, supply chain infrastructure, robust e-commerce channels, and deep customer and supplier relationships. Our extensive branch, store and operational footprint is well positioned with stock and infrastructure to better serve our customers' needs across many regions. Our portfolio of market-leading brands provides access to over 1 million products. With around 400,000 in-stock items across our network, we have a product for every job. We provide supplies and solutions for every industry. Customers can access our products anytime, anywhere through our sales team, in-store, on-site, online, click and collect, and delivery options. Each business within the group has its own distinct culture aligned to the overall vision, which has greatly contributed to our success. We have a clear growth strategy supported by a strong team of people with a proven track record. Our success is underpinned by our core values. We are committed to building a thriving business for the future. We welcome all employees, customers and stakeholders to contribute and participate in our growth as a combined group. Find out more by visiting stealthgi.com.
Thank you. If we can make next slide. So obviously that saves 20 minutes of presenting our organisation, but we listed in 2018 in October. The growth that you've seen and I'm about to take you through has been our journey for the last 3 years. Ultimately, our strategy is to build Australia's leading distribution group of industrial MRO supplies, holding a market advantage position. Importantly, to support that, and we talk about value proposition or strengths, it's really about ensuring that we have an extensive supply chain infrastructure, which we do. A broad line product range is around about 1 million products, as was suggested earlier. But importantly, our positioning is around about being the partner of choice, not only for suppliers, but customers and employees and other key stakeholders. And part of our network growth also involves independent members who own their own stores, but require our business for collective buying scale, but also ourselves. Underpinning all that, obviously, is ensuring in this day and age really robust e-commerce platforms, which we've spent approximately $1.2 million over the last 12 months in evolving that strategy. Next slide, please. We have a really good board structure. So Chris Warden is the chairman and the former West Australian executive for Seven Group Holdings. John Gropoli is the former managing partner of Norton Rose Legal and chairman of Automotive Holdings Group, or former. Simon Poitevin is extremely strong in the capital markets and former captain of the Wallabies, has joined our board recently. And those 3 guys really support me in terms of the growth of the organisation quite regularly. Our market cap today is approximately $12.5 million. We produced an EBITDA of $4.5 million on a revenue base of $70 million at June 30. So at a 4 times multiple, we believe that we're undervalued. And I'll explain the couple of spikes in our share price as we go through the slide deck. Next slide, please. As we've explained, our M&A track record of 5 acquisitions and 1 joint venture with Bisley Workwear has actually put a really good platform behind our organisation, where our annual run rate today is $90 million. We recently completed the acquisition of Skipper Transport Parts, which is the former Coventry's automotive business with a long history. We acquired the regional assets in Port Hedland, Karratha, Albany and Esperance in Western Australia. Prior to that, they had a national platform which they started to reduce, and we've grabbed hold of that business, and we're onboarding that as we speak. Next slide, please. Just a bit of a look inside our organisation to, I guess, from a picture point of view, you get a really good view of what we do, both in store and on site, but also online. The Heatley's business has operated for for approximately 32 years. The C&L business that we acquired has been operating more than 50 years. The Skipper Transport Parts business, a similar time frame. So what we've done is acquired organisations with long trading history and leaders in their own particular markets. Next slide, thank you. One of the areas that we've invested in, we're evolving, and this is more about positioning ourselves to meet the needs of customers, is an on-site solutions model. So it's essentially taking our capabilities from our own stores and our own distribution centres and moving that onto a customer site, whether that be in a fixed location or a temporary location. So a temporary location could be the building roads, building infrastructure, working out in remote locations. We can put inventory solutions on site that has full technologies capability that is aligned back to not only our ERP system, but also with our customers. So what that does, it gives full visibility of the supply chain and replenishment and control of inventory for the customer and also ourselves. It also allows us to keep a low cost operating model by not continuing to increase the size of distribution centres to hold inventory, whereby we, as an everyday commodity, can place those items for convenience and cost down for the customer at their premises. Next slide, please. Just a bit of an overview of our financials in the last 12 months. Our Australian revenue has grown by 17% to 66 odd million, and that is prior to the acquisition of Skipper Transport Parts and only includes 7 months of contribution from the C&L Tool Centre acquisition that we completed in December of 20. Our UK revenue domestically has increased by 80%, and whilst that's at $2 million, that market has been largely in lockdown for a period of time. I'll talk about the growth in that market very shortly, but ultimately our numbers have improved right across the board. So we've increased, as you can see, over a 3-year period quite significantly in our revenue from a group level. Our sales have increased by more than $20 million in Australia. But what's pleasing with that is our scale that I showed earlier of bringing those businesses together has improved our gross profit contribution. We're sitting about 29% at the moment. That's up 9% of last year or the year before, from 26.6. When the business listed, we had a gross profit contribution of 18.5%. So we've basically increased that by 50% in the last 3 years. Next slide, please. From a strategic and operational perspective, in the last 12 months, we've acquired 6 new stores with that, 17 new locations. We've onboarded 600,000 new products in our range, 62 people, 2,500 new customers and 1,400 new suppliers. And at the same time, we've also launched 4 and acquired 2 online presences. Over a period on the right-hand side of the slide, you can see the size of the growth that, again, we've achieved in the last 3 years. Our strategy is very simple. It's a build and buy strategy across our organisations. Next slide, please. The digital transformation has been quite significant and an important part of our business. So online as well as in-store and on-site is ultimately how we connect better with the customer and make them sticky. The investment that we've put into our subsidiary brands has meant now that the sales in C&L Tool Centre, for example, are 25% of total revenue. Heatley sales, which has really been focused on a business-to-business platform, has also now have B2C capabilities. And the benefits of that recently are the acquisition of new contract customers, which is the first of that business and size, whereby we put automation in place and locked in for long-term arrangements. We've launched online platform in the retail sector in the UK, and that's growing 50% month on month, as well as put a new platform in place for members that we have operating within the ISG group on the East Coast of Australia. And that's give them a new portal and access to commercial information, price points and catalogues that becomes important for them to use to generate customer sales and drive them to their store. So in summing that up, we have business-to-business capability, and also we have the retail element of online shopping. Next slide, please. Whilst online is obviously very important and meets some consumers' requirements, we also promote through catalogues and monthly newsletters, as well as a whole range of other specials that we put out across our brands. Ultimately, this is about making sure that our customers are top of mind, books on their desk, and it suits still a number of consumers in terms of how they want to acquire products from our business. Next slide, please. Our strategy over the next 3 years is continuing to centre around a build and buy strategy. So we're looking to increase our scale, increase our competitiveness, and grow our market share. So building a large business that has preferred supplier arrangements as well as customer arrangements is critical. The deeper supply arrangements is around getting our preferred suppliers and making sure that we can add value to them, but also making sure that ranging and pricing, and as a channel of the market, we can be consistent with how we provide our products across the portfolio. 5 different companies operating to meet customer needs is one element, but the buying consolidation power and the efficiency within the supply chain needs to operate separate to that. Our organisation, as you can see, when we provide online, in-store, on-site solutions, is about providing a more simplistic way or convenient way in how we connect with our customers. So greater customer value and better experiences, particularly in this market, is about providing them with multiple buying options. Our business has really worked hard to configure itself to meet the evolving needs of the consumer and the shift, I guess, because of COVID over the last 18 months in the market, and people just want simplicity. So we've created a platform now that allows for that. Underpinning everything is ensuring that we provide satisfactory return to shareholders. So our shareholders have been on a pathway of revenue growth, building scale, getting ourselves set for the next phase. As we head to $100 million turnover, we feel that in 2022 and for the 3-year period thereafter, our focus is now on profitability, a lean model, an EBITDA of north than 8%. We do have some peer groups that we follow offshore in international markets that are generating between 12 and 14% EBITDA. And to do that, we need to obviously implement those elements that you can see within this strategy slide. Next slide, please. Lastly, I guess, from an investment perspective, over the last 12 months, we've taken an industry leading position in Western Australia in terms of the range and depth of service capability within Western Australia market, which is where we have traditionally generated most of our revenue streams. And what I mean by that is we can provide, as one supplier, a comprehensive range of product for multiple industry sectors and multiple customer types in business, in trade, and in retail. We're number 2 in size now to our closest competitor in the West Australian market, but clearly whilst we've created some dominance there, we run a national business and we're growing on a national level. So you could see earlier in those slides the amount of locations we now have. So growing our distribution network becomes key, and driving customers to our stores becomes key. Our addressable market is now sitting at about $40 billion based on our own analysis, and that's in not only the industrial MRO sector, but wholesale trade, as well as building and construction supplies that are available to that. So it's a very fragmented market. It's very favourable. We have some great economic and industry investment that is put into infrastructure and resources sector, as well as engineering and manufacturing, and those markets are actually high growth areas for us. The benefits of the acquisitions that we've made haven't been fully yet realised. So the synergies that we've identified across those two businesses are in excess of $20 million from a revenue point of view. And we should see that we will be able to attain a lower cost to serve as a percentage of our revenue. That's where we believe that our EBITDA will increase. The rise of our e-commerce platforms in terms of growing sales on that, it's up 150% on our 2020 numbers already on an annual run rate. We see that will continue to increase on an annual basis, at least by 100% year on year. A new customer contracts, which we mentioned, provides a vertically integrated model, which is a first for the organisation in the Australian market. And in doing that, that means that we will increase not only our sales from a contractual point of view, but we maintain the traditions of our business, which is 95% of our customers are repeat sales. And repeat sales is either ongoing in store, or it's sales reps that are on the road, or it is through email, online, and a number of other platforms. And lastly, I guess, and most importantly, we see our sales and earning profile to continue to increase. So on $70 million last year, with an annual run rate of $90 million now, is the 30% increase. We see that that's absolutely aligned with our 3-year strategy, and will continue to grow quite significantly, where 3 years ago we listed just before that at 22 odd million in revenue, and getting 90 million in 3 years has obviously been an enormous effort that we're proud of, and we're going to continue to grow in. Okay, David, that's it. I'll hand it over to you. Thank you.
Mike, a great presentation, and a substantial business playing in some key markets. Have you, clearly the resources sector is a key market, and there's a lot of leverage to that sector, and you clearly dominate in delivering into those markets. But you touched on manufacturing and other sectors. How big is the opportunity in those sectors to grow into a market and a market share there?
The market share growth is really from a national point of view. We're strong in very strong in Western Australia, as I mentioned, and Queensland is a new market for us. It was about getting our own operational presence on the East Coast to, and Queensland is a very similar market in terms of what Western Australia does. So we felt that the model that works here can work there. Clearly, we've been cautious about New South Wales and Victoria in terms of the COVID lockdowns and their restrictions. And now that market opens up, we see that there'll be growth in most of those markets, not just in manufacturing, but also in a whole range of areas. I guess our mandate has been pretty simplistic, is to provide an everyday product to every workplace, but also for the general consumer is really a real alternative that somebody can walk into our organisation and buy any type of product. And there's no one company of our type now in Australia. So we have a number of different peers and competitors in each market, but not one that can offer everything to every industry.
M&A has clearly played a role in the growth of the business, and you've been able to bed down some substantial opportunities. I understand you're moving now, the foundation's built, but do you still keep an eye on M&A opportunities? And if so, what's the perfect fit?
We've been really deliberate and consistent in acquisition. So we've turned away more than we've actually purchased. So whilst we've done well to purchase 5, we've definitely walked away from others. I guess it really aligns to our strategy. The perfect business is about one element of improving our leverage, our buying power, and also being able to provide a customer with an alternative. There are the gap between the 2 or 3 what we would call largest players in our market, and then everyone else. We feel that there's a hole there, so we're looking to take that hole and sit just slightly under those multinational groups. We're very deliberate in our approach, and we are always looking at acquisitions. I guess from a debt point of view, having a market cap of 12.5 million, we only really went into debt 12 months ago, or almost 12 months ago. So it's the first time we're doing that, and with covenants and everything else that we're managing well. We boosted up our financial area by bringing in a CFO who was a former group financial controller of Automotive Holdings. So his portfolio was about 6.5 billion. He's now, obviously there's a few zeros less on that, but the principles of of how he manages the capital structure in our organisation, and also our reporting tools, which we have full visibility of every business live in terms of its transaction as well as its inventory, our cash management. Everything has been really advanced. So we're a business that actually has the capability to double in size tomorrow, and we've got all the platforms sitting in place to be able to onboard that.
Good question here. Someone's asked, have you considered initiating an annual membership pricing model similar to a Costco or an Amazon Prime, where there's that stickiness to your customer?
Yes, we do have that already in the C&L Tools business, and the Heatley's business, which is going for a hard launch of its B2C platform in Q3. Everyone does it. So we've thrown out and probably debated this over the last 6 months. What is the right membership, loyalty program we put in place, and making sure that it adds real value. So discount of 5%, I don't think attracts anybody, or getting points that they can build up over a period of time for one-off purchases is not loyalty. So I think we're pretty close to being able to come up with the right structure that when people join us, they actually can speak about us highly and say this is actually value for not only the money that we're bringing, but also the service that we can provide to them. There's a whole range of things that people do. There's some really good programs. There's some not so good programs. We just haven't come to a landing on the perfect one, because we put ourselves in the eye of a consumer and say, would we want to continue to go back? The fortunate part is the long trading histories of our businesses that we own, 30 to 50 years, means that those businesses, you cannot undervalue unmatched basic customer service. So I think that is the fundamental of why we've been successful, really focusing on the customer and really focusing on the old traditional service. The loyalty program will be an absolute bonus for us.
Now, just looking at brands, you've got a number of strong brands. Have you thought about consolidating them, or the longevity of those brands and the history they've built? Is it best to just let them keep running as is?
So making ourselves more relevant with those brands, I think, is important. Again, you've got a number of big players in different markets who continue to promote that, but the value proposition, I guess, at some point really becomes a price point. The mix, I guess, of our strategy is really simplistic, is that we will continue with those brands that and large players who invest heavily and are well-known brands in the market, and people will want those for its tradition. There is a mid-tier range that is a basic brand with a different price point that won't have the life of longevity, I guess, that the big tiers do. But the growth for us, which is where our margin will increase, and this is proven in a number of international markets that we've seen on peer groups that we watch closely, where we can get between 60% GP and 100% gross profit contribution is our own brands or exclusive brands. So we will end up having a mix of our own brand, mid-tier and high-range brands, so that we're providing quality. We won't be going cheap, but what that does, it gives the customer more options. So we're about providing many options, choice for the customer, different price points. And I guess to do that, you've got to have an expansive assortment of range, almost endless.
There's a question here. So remuneration STIs, management STIs are based on revenue and EBIT, but yours is based on NPAT. Is there a reason for the difference?
Well, really simplistically, I'm the largest shareholder of the organisation, and my focus is on NPAT. So NPAT is aligned to shareholder value. NPAT is aligned, obviously, clearly to EPS. So, I don't think I should get anything myself if it doesn't bring value to shareholders. My management or executive team, they are the key drivers of managing the customer and the activity and the people on a day-by-day basis. So I can control the capital investment, they can control the actual day-to-day trading. So that's where the alignment has been made.
Look, and it's, I can say from looking at hundreds of companies, it's a very smart and well thought out strategy, because you're actually linking the STIs to the drivers of the respective elements to the business. So you should be congratulated for that. Now, you've historically quoted in this announcement and this presentation an 8% EBITDA margin through full year 25. Is that an achievable goal, and is it something that you think you will grow from 25 onwards, or is that a level you want to get to and maintain?
So I've been really consistent in the 8% target, and that hasn't just been a number plucked. There's been a significant amount of analysis that's gone into that. It's really about getting scale, and I think the scale of getting to 100 million in revenue allows us to then start being more of a relevant or dominant player. And in doing that, we can be more strategic with our suppliers. We can improve our supply chain and really make sure that that's optimized. We can, through collective buying power, negotiate better prices, better long-term incentives as our volume spend goes up. But also what happens with these new contract customers, it's business that comes into our organisation that our traditional cost to serve, if it's not 22 or 23%, then on new contracts, it should be sitting at somewhere between 12 and 14. So you actually achieve a higher margin because your infrastructure is already in place. It's the people element you need to put to that. So if you've got your technology that we've invested in, you've got your supply chain infrastructure there's in place, then it's only the variable component. That's where we're going to increase our margin. Our target is clearly on the peers that we've looked at, 12 to 14%. Our strategy is aligned exactly to that strategy. It's tried and tested in those businesses, and those businesses that are in international markets, we don't believe that anybody operates under the same methodology within the Australian market, and that's why we're doing that. But having our own brands is going to be key to that. Our margins in the UK, from an online perspective, are about operating at 53, 54%. So, as my chairman always says to me, no one ever negotiates too hard on online sales. So whereas they walk into the store, they will. So I guess having that blend really allows us to, achieve greater than 8%. And that's, in my view, really conservative.
Well, I can tell, Mike, your shareholders, looking at the questions that come through, like you being conservative and like you being consistent. So congratulations for that. A great presentation, a strong foundation clearly built with a big platform and a clear strategy ahead. So, Mike, congratulations, and we look forward to following the story.
Great. Thanks, Dave. No, I really appreciate it. Thank you.
Well, thanks, everyone, for being part of this Share Cafe Hidden Gems webinar today. I hope you found a hidden gem, and at the very least, you'll have a few more companies to keep an eye on as they execute their plans over the coming months. Enjoy your weekend, and we'll see you next week.